So a question that our clients always ask us, is it deductible? So what do we want to tell them? First, we want to explain what is the deduction. So we just got out of the credits section, and credits are all about after you've calculated your tax liability, we are taking dollar for dollar off the taxes you owe. A deduction is going to lower your taxable income. And a deduction can be taken as a standard deduction or an itemized deduction. Okay? And the standard deduction is by filing class, filing status. And you guys should all know that one. Itemized deductions are where you list out all of the different things that can be deducted. We're going to go over that in a little bit here. You list out all the different things that can be deducted, add them together, and reduce your income by that amount. Okay? Most people right now, I believe 91% of Americans are taking the standard deduction. Okay? And any deductions that you're taking, or any itemized deduction that you're taking, are going to be taken on the Schedule A. Okay? And we're going to get on the next slide here, all the different lists of deductions. But I put on here adjustments. Adjustments are like deductions. They lower your taxable income. The adjustments are going to be on your Schedule 1, really the page 2 of your Schedule 1. Well, 1 and 2, really. And actually, I guess this is wrong. An adjustment can lower or increase your income, right? Because unemployment is an adjustment to income. Sole proprietor profits are an adjustment to income, and those are adjustments up. Okay? Only direct expenses are allowed on adjustments. So there is no thing like a standard adjustment. Okay? These are going to be taken on the Schedule 1. Some things that are adjustments, and we'll go over them more in depth. Educator expenses, self-employment health insurance, student loan interest, IRA deductions. Those are all things that lower your adjustment. I didn't touch on raising your adjusted income here. So let's talk about the deductions on a Schedule A. Okay? Here are really the only categories right now. Okay? Mortgage interest, charitable giving, medical expenses over 7.5% of your income, state withholding, and state real estate taxes. On the federal side, there is no worker business expenses. On the state of Hawaii side, there still is, but the state of Hawaii is slowly but surely bringing up their standard deduction. I think it's going to be the same this year, but in 25 it doubles to $8,000 for a married couple, and in 27 it doubles again to $16,000, and I believe by 2029 the standard deduction for Hawaii will be about $25,000 for a married couple, half that for a single. So they're moving the way of the federal numbers, but it's slow going, we're going to say. Okay. All right. So what do I say here? These are all the different ones that we can do here. So what do we have? Charitable contributions must be made to a qualified organization, a church, a research center, a boys and girls group, but it must be to a qualified organization. Okay, the taxpayer cannot receive anything as a benefit. Okay, no, they can't receive event tickets. They can't receive Hula Hula Chicken anymore. They can't receive anything as a benefit if it's going to be considered a charitable contribution. The auto rate is 14 cents per mile, and the maximum amount. So a lot of the times my clients will ask me, "What's the maximum amount I can give to charity?" 60% of your income. So when a client asks, how much can I give to charity? You can deduct up to 60% of your income. They go, oh, I didn't give that much. Well, yeah, you tell me how much you actually gave. You don't just look for the biggest number. Okay? One thing I didn't put on here, but I really want to reiterate, is right now, okay, here we go. I did put it on here. The taxpayer needs to have documents before filing. I've been seeing a lot of clients right now that's telling me their church is not tracking. Their church is not tracking, or maybe they're tracking only credit card deposits because it's easy. Really? Yeah. And I had one client that they had their credit card transaction worksheet. They went to their church and said, "Church, can you write me a letter and say that I gave you this money?" The church said, "No, we will not." Okay, we decided not to have that charitable giving on there, because what the IRS is saying right now, and they won in a court case, that if you do not have the slip of paper from your church before you file the tax return, if you can even go get it after they ask, too late. If you don't have the charitable contributions saying that you did not receive anything as a benefit before you file, the IRS can take it away, even if you can show proof that you paid it. Okay? So those are going to be for cash contributions, cash charitable contributions. We have our non-cash charitable contributions. You guys all know this, $500 without your paperwork. That's as high as you can go. Okay? If you're gonna have the little slips of paper that Goodwill gives you, or whatever, it's gonna have the organization's name and EIN, the date, the description, and the value. How many of our clients just bring in a bunch of blank slips of paper? That's what my clients do. And we try to help them out and try to reconstruct what actually happened. But these are the real things that we need on there. If a single item or a group of items is more than $5,000 at once, there should be an appraisal. The IRS says there needs to be an appraisal, but at a minimum there should be an appraisal. Okay, and that is $5K at once. So either as one single donation of a truckload worth of clothes or similar items, or if it was one oil painting that they gave away for more than $5,000, it needs to be appraised. Okay, auto contributions. You need the 1098-C. If they don't have the 1098-C, you can just go with the $500. Because you get the higher of $500 or the actual sale price. I'm seeing that these companies are not providing actual sale price. That you give them the card, they say you got a $500 deduction, good luck to you. They're not really tracking what happens if that car sells for $2,000. This person should get a $2,000 deduction, but they're just not. Yeah. Mortgage interest. Here's some things to just keep in the back of your mind, especially with our big homes, big expensive homes out here. If the total debt of all personal mortgages, these are not rental properties, these are not commercial mortgages, but if their first and second home have a total debt load of $750, they start to get limited on how much itemization how much mortgage interest they can deduct. Okay, this is only if they have a loan after 2017. If they have a pre-2017 loan, it's $1 million for the total of all properties. They have one loan that started before 2017 and one that started after. It gets trickier, but you prorate it. Okay, and then qualified home is your first or second home. Okay, can't be a rented home. That would be a rental property. Rental property would not count towards the $750,000 of total debt. Okay, and we've got splitting loan payments. This is a big topic. Maybe you've got kids are in the home, they're the working ones, but they don't have the loan in their name, but they're the ones paying the mortgage. If they have an equitable ownership, okay, and make the payments, and actually make the payments, they can qualify to take it on, even if it's not in their name. They have no ownership of the home, but they have equitable ownership. They're paying the bills. They plan on inheriting it when their parents pass. You know, they want to keep it in the family. If they have equitable ownership, it really helps if they're living there, but they don't have to be living there. But it helps. If they're not on the mortgage, they're not on the deed, they got no name on it, but they're paying the bill, they can still claim the mortgage interest. Okay? If they don't have their name on it, they don't pay for it, they probably shouldn't be taking it. Okay? Yeah. Yeah. You can move the payments between taxpayers so long as they all have equitable ownership. So you can, definitely done things like, put 2/3 on one taxpayer and put 1/3 on another. Even if that's not how the payments were actually made. So long as they all have equitable ownership and they're all making some payment towards it. Okay. Let's see here. I think that's the biggest one. The splitting of the loans is, I'm seeing that a lot more often now, where the people paying it are not necessarily the people on the loan. Okay. And so what you want to find out is, do they have equitable ownership? This could also be in a case, I wouldn't recommend anybody getting into this situation, but with rates higher, if somebody assumes somebody else's mortgage, but don't do it legally. Maybe the mortgage isn't in their name, but the property is, or something like that. If they have equitable ownership, if they would be harmed by the home being taken away, foreclosed on, removed, if our taxpayers would be harmed by that, we can make sure that they get some some mortgage interest deduction. Yep. Okay.
Sam,
Yes.
did you say that if they're renting it and it's over 750,000, they can take the full mortgage interest?
Yes. So
Okay.
if they're renting, so let's say they've got a personal home and a rental property. Their personal home, they've got a debt load on it of 650,000. So they're 100,000 under. On their rental property, they've got another 650,000, or even $1 million. They've got $1 million loan on this rental property and 650 on their personal, fully deductible on their personal, and on the Schedule E, they can't. They fully deductible on the Schedule E as well.
Oh.
This limit is only for Schedule A.
Oh.
Right? So if this is and then you can get even trickier in a mixed-use property. A property that's valued more than $1 million, but 25% of it is rented out. Well, now you've got 75% personal, 25% rental. That whole thing's deductible, but 75% on the Schedule A, on the Schedule A, and then 25% on the Schedule E. Yep.
Well, ultimately, as long as they have the rental, there is no limit.
So if they had 3 properties now and 2 were personal, but yeah.
I just have a
Yeah.
client. She just moved to Florida, so
Yep.
she just has a rental property still worth over 750. This doesn't apply to her now.
Nope. As long as they're not claiming it as a personal residence. Yep.
Are they doing away with this coming 2025?
No rules have been changed. That's
No rules.
no rules have been
I thought it
changed.
was
Nobody's
slated for
talked about it.
25,
Wait, I'm
no?
sorry. I'm
Yeah.
confused now. So if the property is rental and it's more than 750, then they can use that they can claim that 100% under Schedule E,
Yep.
right?
Yep.
Okay. But if it's personal,
If it's personal,
then it will be on Schedule A,
and yep,
and then it will be 100% on there.
as long as they didn't go over the 750 on the personal side only.
Oh, because you can only claim up to 750.
You can only claim up to 750 of debt,
After,
right? Yeah.
Okay.
And that's going to be in box 2 or 3 of the 1098. Okay, that's in box 2 or 3 of the 1098. If it is the first year that they have done this, and this is probably a little bit more advanced than we need to take it today, but if it's the first year, this number is for the average debt over the entire year. So if they bought the home in June and it was $1 million, their average, and there was no other homes before that, their average debt over the year is $500,000 because they only had the debt for half the year.
Oh, okay.
Okay, so you get to kind of average it.
Yeah.
But what I tell them is, hey, you're getting all your mortgage interest this year, but next year you're only going to get 2/3 of it because you've got $1 million loan
Yeah.
and you're over that 750. Yeah.
Correct.
So, and I'm seeing a lot of government workers out in Kapolei getting hit by that. A lot of government workers moving out here, buying a $1 million home and putting not very much down. That first year they'll get all the mortgage interest, but the second and third year they're getting limited. Okay, excellent question on this. So if it's your first or second home for the mortgage interest on your personal side, then it caps at 750. Kind of speaking to this a little bit more, Mel, I did have a client who had 2 properties and the banks messed up. They said that both were for personal, when one was for personal and one was for rental property. and the bank messed up and put the wrong address on the rental property. And so the IRS did come back to my client and say, hey, you've got, $1.5 million of mortgage over these two properties. We're going to limit you. We're going to take away all your itemization. But they didn't look and see. He didn't take the mortgage interest on his itemized side. He took the mortgage interest for his rental property on his rental property. He took it in the correct spot. But the IRS saw the forms. They added stuff together and denied it. I did end up working. It took about a year, but I got that corrected. But yeah, if the bank misrepresents and says, oh yeah, this is just personal, and the IRS gets two 1098s, sometimes they're not even looking if there's a Schedule E on the return. But if there is a Schedule E on the return, we could just explain it to the IRS, right?
Yeah.
That it was not, the taxpayer is not doing anything shady. They've only got one personal property, and the other one is a rental. Okay. Adjustments. So we're getting to the end here. So adjustments to income, I have the increases. So self-employment income, rental income, unemployment, those are increases to income on the schedule 1. These are on the Schedule 1. Okay. Also, other income. I want to point this other income out for anybody whose client comes in with something they don't understand. A 1099-K that they don't understand what's going on. A other income where they get a tax form but they don't know what it is. Or you just want to report some income to the IRS and explain what it is. Use this other income section. It should be line 8Z on the Schedule 1. Line 8Z on the Schedule 1. So you can inform the IRS, hey, here's this income that you're going to see reported for my client. Then, on the decreases to income, under other adjustments, you're going to offset this income that you did on line 8. You're going to say, so what you might do is, and I'm probably going to do this in the next couple of weeks, is I've got somebody who's an 80-year-old, and her son, who's, probably 40s, was using Cash App, using mom's name and social, and so a 1099-K was reported.
Okay.
So now we have to go on mom's return. We got to go put this $30,000 of Cash App money. We're going to go add it to the return, and then we're going to take it off, and we got to point to the son. We got to give son's name, social security number, and address so that we can point, hey, this is really where the money was. And then, because I'm helping everybody, I'm going to go on the son side and say, this is really what this was. I don't know yet. I haven't got the full story, but I think it was like a buying and selling in 2022. Maybe I'm making it buy sneakers for $100 and sell them for $300 kind of thing.
But they use a Cash App.
But they use the Cash App
under the mom's
name.
Oh.
I don't know yet. I gotta bring the son in for an interview, but
it looks like it's the same problem with some of the other people that came last year that
Yep.
IRS was holding it.
Yep.
They didn't even know what it was.
Well, were you helping?
Yeah.
I don't remember their names, but yeah, they had the Cash App thing.
Correct.
Identical. It says BlockFi on it.
Correct.
That's the one. That's the one. So yeah, this is the exact same thing. These people are doing the same thing. Lucky smaller numbers than the other guys. And I think I did get that one resolved. They haven't been back in a couple of months. So yeah, I think I got that one resolved. But that's what adjustments are really good for. Now, of course, because of my situation, the mom in this situation didn't know about this until she got a CP 2000 a couple days ago, saying, "Hey, we found $30,000 with like $15,000 in taxes. So now we're gonna fix all that." Yeah. Okay. So adjustments to income. This is going to be important. If the taxpayer has income they don't know what to do with, you report it and then you take it off if that's the correct thing to be done with it. Okay. Decreases to income. So self-employment. You're going to add on your self-employment income over here, and then half of your self-employment tax comes off. If the self-employed person paid for health insurance, they can get a health insurance deduction, but this is the sucky part. Only if no other health insurance is available. So if they have a spouse that works and is offered a plan, even if it's garbage, if they're offered a plan, even if they don't take it, a self-employed person cannot get their own health insurance deduction. And so that's a tough one. Educator expense, that's gone up to $300. I think it's still at $300.
Last year was 300.
Yep, last year it was $300. It went up from the $250. A health savings account, if your taxpayer says, hey, I contributed to my health savings account, if that was on his own and not through an employer. And then, actually, health savings accounts are really rare out here because you must have what's called a high deductible plan. And I don't know a lot of employers offer the high deductible
But
plans
I don't
out
think
here.
State of Hawaii does that because they're required to have.
You're correct. Yeah. So these are going to be super rare out here, but you might see it from somebody moving into the state.
Into the state.
Yep. An IRA, individual retirement accounts, if they are funding their IRAs, they would get a $58.95, I believe. They would get some tax form for their IRA. If it is a traditional IRA and they meet the income limits, it's a reduction in income, so it's an adjustment down. If it's a Roth style plan, no adjustments down.
What happens if it's an RMD?
So required minimum distribution would be income to the taxpayer. They'd get a 1099-R. Yep, this is money going in. Yep, money going into an IRA. Okay, this is also where if the taxpayer is paying back their student loan interest will come into play. I think it maxes out at $2,000, regardless of how much is paid per year. And the income limits are pretty low before it phases out. Okay, so a lot of these adjustments, they're nice to have, but they're not like credits. They're not make or breaks. The credits are really where the money's at. Yep, these are nice to have, and if you can find some little adjustments, save your taxpayer, maybe $100 here. The self-employment stuff, that's just going to do it itself from the self-employment tax. So that's really those are really the main adjustments. So that's it. That's for tonight. If anybody has any questions, we've got a few minutes here for questions, and then we get to do this all again next week. So yeah, I hope you guys find this informative. I really do enjoy doing this. It is a lot of fun.